My name is Robert Wheeler. I am the branch manager in the Richfield office of Western Ag Credit. I've been with Western Ag Credit for 35 years. I will be talking about financial statements, understanding them, and completing them. Core financial statements are the balance sheet, the earnings statements, and the cash flow statement. The balance sheet is the cornerstone of the group of financial statements that are necessary to accurately analyze a business's financial position or performance. A balance sheet is a snapshot of your financial position at any point in time. You can take a balance sheet at any time, whether it's in the fall or the spring. They will be a little bit different depending on your crop and cattle inventories at the time, but it's just a snapshot of where you are at any time during the year. A balance sheet also shows the cumulative effect of your past investments as well as the type of financing decisions that you have made for your operation over the year. It basically is just a status report of what has changed in your financial position. The components of a balance sheet, there are two sides to a balance sheet. On the left side are the assets, which show basically everything that you own or that you have investment in, and the right side of a balance sheet are your liabilities. They show the debts that you may have as well as the owner's equity or the net worth that you have in your business. An example of a balance sheet. The balance sheet on the left side lists all your assets. The top part of the balance sheet has your current assets. The middle part of the balance sheet has the intermediate term assets, which are those that are from 1 to 10 years. And the bottom part of the balance sheet on the left side contains your long-term assets, which is basically your real estate. On the right side of the balance sheet, the top part has your current obligations, which includes things such as your operating loans, accounts payable, etc. The middle part of the balance sheet has your intermediate liabilities such as equipment debt. The bottom part of the balance sheet contains your long-term liabilities, real estate type loans. There are basically three classifications of assets. As we discussed a little bit when I was showing you the balance sheet, there are the current assets, which are those things that are sold in the normal course of business or can be within a year's period of time or can be converted to cash easily. You have your intermediate term assets, which are basically those assets which have a life from 2 to 10 years, and they're not quite as easily converted to cash, and it could disrupt your operation if you try to convert them to cash. Long-term assets are those that are usually over 10 years and they're more of a permanent nature, such as real estate, and if you did try to sell one of these, it could and definitely probably would upset your operation. To give you an idea of the different types of assets, your current assets are things such as cash and savings, your accounts receivable, marketable securities such as if you have gold or silver, your cash and growing crops, marketable livestock, feed. Those are some of the examples of current assets. There's also prepaid expenses and supplies. They're a little more complex than the others, but they are part of your current assets. You get into the intermediate asset, there are production livestock, your machinery and your equipment, retirement accounts if you have any, your household, personal type goods, vehicles. And you get into the long-term assets, they include real estate. There's also notes receivable that you may have that would be in there, and if you have interest in other entities, the ownership in those entities could be on a long-term asset side. Classification of the liabilities. There are three different classifications of liabilities also. There's your current liabilities, they're obligations that must be paid within a 12-month period, your intermediate or debts that are due usually within 1 to 10 years, and then your long-term obligations, which are those that are typically over 10 years. Current liabilities are your operating loans, credit cards that are paid off monthly. Just encourage you to pay your credit cards off monthly. Accounts payable, your accrued rents and taxes, and then your current portion of your long-term debt, both your principal and your interest. They should be up in your current liabilities because they are things that have to be paid within the year's period of time. Your intermediate liabilities include your livestock loans, your equipment loans, if you possibly have a life insurance policy loan, and some leases. All leases are not considered intermediate liabilities, but some leases are. And then credit cards, if you have credit card debt that you are not paying it off monthly, it basically becomes a term loan, so it's an intermediate term liability. You get your long-term liabilities, and that includes basically your real estate loans. What is net worth? Net worth is basically the difference between all of your assets, your total assets, and your total liabilities. It's basically what you have invested in the operation, and it's a way to show how much earnings you have retained in the operation. What does a balance sheet tell us? When you look at a balance sheet, it gives a lender an idea of what type of assets are available there to collateralize a loan. It indicates the performance your business has had. If you compare two balance sheets, one from the previous year-end and one for this year-end, you can see the differences in your liabilities, in your assets, in your net worth, and it's a good comparison to see what is happening in your operation, whether you're making progress or whether you're falling behind. And it also demonstrates liquidity and solvency. I will not go into describing what liquidity and solvency is. These concepts are explained in the 5 C's of credit presentation. If we go into now the earnings statement, what is an earnings statement? The income statement provides details as far as your income and expenses of the operation. It contains information to determine if an operation has been profitable. And it shows can show the same thing if you look at a historical statement or a projected statement. They basically can help you determine the profitability of an operation. We'll look at an example of an earnings statement. The top part of the earnings statement has all the income on it. When you look at an earnings statement, they come in various different forms. The one that we're showing you here has a history up there that you can put 5 years of history on there. So you can spread your tax returns or profit and losses or whatever type of information you have. So it gives you a history of your income and expense. And then there's a column on this one for basically a projection of the same. But the top part shows your income. The middle section of the earnings statement shows all the expenses. The different expense categories are on there, and they follow very closely with that of your Schedule F on your IRS returns. And you get down a little bit further towards the bottom. This is where your non-farm income, if you have salary or other type of non-farm income, it will show up there, as well as your living expense has to be taken out, depreciation expense, and then towards the very bottom is where your debt payments are shown. And after you have your income less your expenses and take into consider your non-farm income and non-farm expenses, then you have your debt service, and it comes down to a margin at the bottom, which we hope is a positive margin. If not, we need to make some changes in your operation. The components of the earnings statements, of course, the income. This is the value of the products and services that you would sell in the normal course of business. You also need to take into consideration, though, you'll sell things in the normal course of business, but you may have possibly sold more inventory or less inventory. So your inventory, your beginning and ending inventory, play a critical part in your income to know if your operation is really generating a profit. Basically, your total revenue, it's your cash income adjusted for your beginning and ending inventories. Whether that's a negative figure or a positive figure, you'd need to take that into consideration to come down to what your true income is for the year. You get into the expenses. They're basically the costs associated with producing that revenue for the same period of time. To determine total expenses, cash outlays are calculated, then they're adjusted also by your beginning and ending payables and prepaid expenses. The same as income, you're adjusting income for inventories. You have to adjust your expenses if you have payables or prepaid expenses or accrued liabilities there. There's also your non-cash expenses, depreciation. We will not go into a lot of explanation of depreciation, but it is something that needs to be considered. Whether you're keeping equipment for a long period of time or rolling it over quite often, you do have to have that depreciation in there to know that you do have the ability to replace equipment when it's needed. Also, other components of the earnings statements are the gains or losses on capital assets. Your net farm earnings is total revenue less total farm expenses. And then there's the non-farm income, as we talked about a little bit, which is generated. Non-farm income is also important, even if we're looking at an agricultural loan, because it will help us determine whether you need to live off the farm income or if you can provide your living from your non-farm income, and if it can be a help in supporting the farm from that source. Earned net worth. What is earned net worth? It is the measure of how profitable the business is over a period of time. How do we calculate earned net worth? Profits or losses that come from the earnings statement go to the balance sheet unless they are diverted in the form of you give a gift to somebody or you withdraw them and use them for living or other sources such as that. We need accurate balance sheets to determine earned net worth. We need the beginning and the ending so that we can see what has happened throughout the year. The following things are needed to try and reconcile that earned net worth to get to the bottom line as far as what is really earned versus what the balance sheet just shows you, which could have increased or decreased from asset appreciation, things like that. But you need to know if there was any gifts or inheritance or capital either received or paid out. You need to know what type of things have been purchased throughout the year, real estate, equipment, or breeding stock. And you also need to know what things were sold, what type of capital assets were sold. And also, if by chance you happen to forget to put something on a prior year balance sheet, you need to make the adjustment for adding it to the new balance sheet. To arrive at your earned net worth, you basically take your beginning balance sheet and ending balance sheet and the net worth of those two, and then you add or subtract those items that we talked about to make sure that we're getting to the bottom line of were you really profitable. So why is that important? As mentioned previously, your balance sheet, you could show that you had an increase in net worth, but that net worth could have been accumulated just by asset appreciation, for example. So that would not be a true gain to you from profitability. It's a gain to your net worth, but not from profitability. And we want to try to get down to the basics of, was this operation profitable and is it showing up in the earned net worth gain? Again, those things that will influence that are appreciation of assets or your operational profits and inheritance will all have a factor on that. We'll now move to the cash flow statements. Basically what a cash flow statement is it covers one operating cycle, shows all the cash coming in and all the cash going out. We talked a little bit on the earnings statements of cash, but then we also talked about the adjustments to inventory and payables and so forth, and those are called accrual adjustments. On a cash flow statement, it is strictly just the cash income and outflows. They can be summarized with your past transactions or to help you use them in doing future transactions. They just show cash transactions. They don't show anything that is non-cash, and so they don't really show the profitability of the operation. There's an example now of a cash flow statement. This is one that we have used here at Western Ag Credit. The top part of this statement is the income. It is spread over a 12-month period of time so that you can put your income in the appropriate month when you may sell your hay or your calves or whatever your commodity may be. You go down towards the middle part of the statement. It has the expenses. These expenses follow the same as on your earnings statement, and you again can spread them over a 12-month period so that you can kind of budget and see how your expenses will go out during the year. And then towards the bottom are where your debt payments are. And the budget and cash flow that we use here, if you incorporate all your income and your expenses, it will actually go through a calculation so that we know how big of an operating loan you may need as far as how your income flows in and your expenses flow out during the year's period. The uses for cash flow statements. They're used to help you develop your marketing plan for the year as far as your inputs and your outputs, which basically are your income and your expenses. They plan financing needs, and they can help you also project your interest costs over the year's period. And they also have your loan payments on there, and you want to, if possible, try and coincide your loan payments with when your income comes in. If you can do that, it limits the amount of money that you have to borrow to make those payments. And these cash flow statements will also help you to establish your peak borrowing needs, as I talked a little bit earlier. How do we develop a cash flow statement? What we can do to help you out is you want to take your actual income and expense from prior years and use that a little bit to help develop the year that's coming up. You may have had some changes in your operation, but this is a good source to help you get things in line for what you think will happen during the next year. When we were looking at the earnings statement, we had that 5-year history. That 5-year history would be very good to help look at what your expenses have done over that 5-year period and make any adjustments from them for things that have changed or that will change moving forward. A good thing too is if you have hay, cattle, sheep, whatever your commodities may be, it'd be really good to be able to develop a budget for each one of those different enterprises. That way you can tell if that particular enterprise is profitable or not. You combine them all together and you may be profitable, but you're not sure if you don't have individual enterprise budgets whether each enterprise is profitable or not, and why be involved in an enterprise that's not profitable if you don't need to. Things to remember when you're developing a cash flow budget. Be realistic. Don't overestimate your yields or your weights of calves. Those things, it's never good to come in a lot less than what you were hoping for. So be realistic. It makes you feel a lot better if you can come in and outdo the projections that you had planned on. Another thing is to use reasonable commodity prices also. We've had a period of time when we had very high cattle prices, high milk prices, and high hay prices. Those are not the prices that you want to use when you're looking at a budget, especially if you're looking for long-term to try and develop something when you're getting a long-term loan. If you're in a cycle that the current year is high and you're just doing it for the current year, you could use the market prices that are there, whether they're $3 calves or dollar calves, but you want to be realistic for the period of time you're looking at, whether it's a one-year budget or if you're trying to develop something to help support a long-term loan. You need to consider all your expenses, and we all know that something always comes up during the year, so you need to be able to build a little bit of a buffer into your expenses so you can cover that unexpected expense that may come along. Again, if you're looking at long-term loans, try and use more of a long-term price and not the real highs or the real lows in the different commodities. So how do all these statements work together? With all the statements, one can see whether the business is profitable or not. They help determine the strengths and the weaknesses of the business, and they help you keep informed for future decisions of the business. All these things will work together. Your earnings statement, your cash flow statement, and your balance sheet, they all work together to help you decide whether this operation is profitable, whether you need to make changes going forward, and I would use them. It's very good if you could possibly get year-end statements on all of these to compare from one year to the next. But I just encourage you strongly to work with these statements and use them to your benefit, and they will also benefit your lender when you try and go in for a loan.